The Federal Reserve just made a decision that has me shaking my head, and they decided not to cut interest rates today. And I'm going to be straight with you. I'm disappointed. And I thought this was the right time to cut the interest rates by 25 basis points at least. And I'm going to explain why throughout this video. And for anyone who's been following my live streams, or if you're a part of my private group, which you can also join by visiting 5 com/community, where I talk about the TSP, 401k, IRA, and the stock market in general, you know this is not a new topic for me. And I've been sounding the alarm about the labor market for months. And it's been nagging at me like that feeling you get when something is just not right, but you can't quite put your finger on it. Well, now I can put my finger on it, and it's not pretty. The latest unemployment numbers came out showing 4.2% unemployment. And on the surface, that doesn't sound terrible, right? But here's what they're not telling you in the headlines. Long term unemployment just hit a 2 year high. Think about that for a second. People are not just losing jobs, they're staying unemployed longer. And it's all because companies have slammed the brakes on hiring due to these sky high interest rates and all the economic uncertainty floating around. Now, let me tell you what's actually happening out there in the real world, because this is where it gets really concerning. And companies have absolutely pulled back on hiring. And I'm not just talking about being a little more selective. I'm talking about a full scale retreat from the job market due to AI adoption and longer than expected higher interest rates. And I can tell you firsthand as a business owner that I don't need to hire as many people as I used to, because I have the AI to do a lot of the work for me. And they may be good for the business, but that's not good news for the employees, right? And the most recent unemployment data showed long-term unemployment has hit a 2 year high. And this really is now sinking in because, well, yeah, that's a direct consequence of a slowing job market. When hiring slows down, the people who are already out of a job have a much harder time getting back in, and they stay unemployed for longer. And companies will do whatever they can to cut costs. And they're always going to start with labor because it is the number one most expensive line item on their income statement, right? And why would they borrow money at a much higher interest rate to hire people? And just last week, CNBC ran a piece where a career coach was quoted as saying the job market is trash right now. And that's a pretty blunt assessment, but you know what? She's not wrong. I've been seeing this firsthand in the stories people share with me. And here's where it gets even more frustrating. And there's this thing happening that Congress actually got a report about, and they're calling it ghost jobs. And companies are keeping job postings up on their websites, not because they're actually hiring, but because they want to look like they're growing, or they want to collect a pile of resumes for someday. And meanwhile, you're out there sending application after application into what feels like a black hole. And I have talked to clients who have sent out 50, 100, even 200 applications and heard nothing back. And that's not normal, especially when these people are highly qualified. If I were in your shoes right now, maybe thinking about a career change or worried about what happens if your company starts making cuts, I would be playing this very carefully. And this whole cycle of uncertainty just keeps feeding on itself. And it all comes back to the same thing. The job market is much weaker than those headline numbers want you to believe. Now, here's what the numbers are actually telling us when you dig a little deeper. And the private sector payroll for May 2025 shows some pretty weak numbers, or job creation. And these are the private companies, that the ones that drive most of our economy, and they're basically saying thanks but no thanks to new hires right now. The official non-farm payrolls report for May was much better. Sure, we added some jobs, but when you break down where these jobs actually went, it paints a very different picture than what the headline unemployment rate suggests. And Daniel Zhao from the Glassdoor, whom I partnered with last year, said that the May job report still has everyone waiting for the other shoe to drop. And this report shows the job market standing tall, but as economic headwinds stack up cumulatively, it's only a matter of time before the job market starts straining against these headwinds. And when you dig into it, a clear and somewhat worrying pattern emerges. A router analysis of the May jobs data confirmed that the overwhelming majority of job creation in this country right now is coming from just a few sectors. And we're seeing a slowdown, significant slowdown in manufacturing. Leisure and hospitality, which was the biggest comeback story after the pandemic, has largely stalled out. So when you see the private sector pulling back while the government sectors are the only things keeping the headline numbers positive, this is a major red flag. And it means that the foundation of the job market is not nearly as strong as it looks from a distance. On the other hand, the latest inflation report is showing a modest increase year over year. CPI, or Consumer Price Index, for the month of May came out with a 0.1% increase month over month, or 2.4% year over year before seasonal adjustment. But here's my point. The Federal Reserve's decision to keep interest rates at 4.25 to 4.5% could become a long-term disaster for people looking for work. So what did Jerome Powell have to say about all this? Well, let me tell you, the man gave his usual carefully crafted speech about why the committee decided to keep the rates where they are. And you can find the full press conference online if you want to torture yourself with Fed Speak for about an hour, but I'll save you the trouble and give you the bottom line.
Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction. And I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers about the outlook for the economy.
Look, from my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned to right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans. Small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Great question.
I mean, we're trying to restore price. Best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
That's a great
just
question.
Look backward at the data, that's what you would say, but that's not. We have to be forward looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward looking look would lead you to a neutral stance, but we can't, we have to look at that. And because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass through of inflation and what's going to be the effects on spending and on hiring and all those things.
Now, let me give you the breakdown of the summary of economic projections, or SEP. And it comes out in March, June, September, and December every year. So the next one won't come out until September, when we expect the Fed to start cutting interest rates. This SEP is basically the Fed's official report card and forecast, where each of the committee members give their anonymous prediction for things like inflation, GDP, and of course, interest rates. Okay, so let's first take a look at what the GDP says. So right now, the Federal Reserve is expecting the GDP to grow at 1.4% in annualized rate. Compared to the previous one, it has decreased from 1.7% to 1.4%. So that's how you read it. And if you look at the below number, that is from the March projection. So that's how you do the comparison, is where the quarterly SEP was in the previous one. So the previous one in March said 1.7%, and now it is showing 1.4%. And the unemployment rate is projected to go up higher at 4.5% to finish the year in 2025, compared to 4.4% in the previous March SEP, or summary of economic projections. And then the next one is the PC inflation. So they are projecting, and when I say they, the Federal Reserve Committee, they believe that PC inflation will increase by 3% by the end of the year, compared to 2.7% at the bottom for the March projection. And the core PC is also going up by 30 basis points at 3.1%, which is increased from 2.8%. So right now, the Federal Reserve is looking to finish the Fed funds rates by the end of the year down to 3.9%. So that is pretty much aligning with the two rate cuts of possibly 25 basis points for each rate cut, or maybe just one rate cut of 50 basis points. So we're not going to get the new one until the next FOMC, well, not the next FOMC meeting, but the one after that in September, when we get the new SCP, which will give us a better clue on whether the Federal Reserve is going to cut more interest rates, possibly going from 3.9% to 3.5% if the labor market continues to weaken over the year, or they could just maintain the rates the way they are at 3.9%. So stay tuned. Be sure to subscribe if you haven't done it already. And these dot plots I'm showing you right now are on the third page of the SCP that reflects what each U.S. central banker thinks will be the appropriate midpoint of the Fed funds rates by the end of every calendar year. And like I said, we're going to get this in March, June, September, and December, or 4 times every year. Now, the dot plot has 19 individual projections, and they're all kept anonymous. So no one knows which official or governor is which dot. The dot plot was created way back in, well, I shouldn't say way back, pretty recent in 2012, when the economy was still recovering from the Great Recession, to show a form of guidance for the Federal Reserve. And you also don't want to look at the 2026, which is the middle circle here in the red right here, okay? Or 2027, which is beyond that over here. And that's going to be way too far out. And I wouldn't take them too seriously, because they will change every quarter depending on the economic data that we receive in between these quarters. And the last dot plots from December show that a majority of the Fed officials were looking to maintain the Fed funds rates between 3.5 and 4% by the end of 2025. But the previous SCP in March showed that they were looking to cut rates twice, only twice in 2025, going from 4.25 to 4.5% to 3.75 to 4%. And that's cutting 25 basis points in 2 separate meetings, or cutting 50 basis points in 1 meeting. And we'll see how that goes. But the SCP from today, or in June, shows that they're going to keep the rates the way they are, because they're nervous about inflation spiking up with tariffs. And Jerome Powell said it multiple times during the press conference about the uncertainty with inflation and other economic conditions. He also emphasized that things could change if unemployment rates start to rise. And so people who left the workforce are having a hard time getting back into it. And that's why the long-term unemployment is at a 2-year high. However, companies are not laying off enough people to make the Fed raise its eyebrow. So Jerome Powell's argument of the 4.2% unemployment rate justified the committee's decision to keep the rates steady where they are. And remember, they still have 4 meetings remaining in 2025, and Wall Street is betting the Fed to cut interest rates in September instead of July. And that's starting to look more likely because the Fed wants to see how inflation goes in the summer months. If inflation stays at 2%, then they could cut rates in September. If unemployment starts to rise, they could cut rates at the next meeting in July. And it's going to depend on several other data points like JOLTS, PC inflation, and the GDP. So if you look at the dot plots here, the vast majority of the committee members want to maintain the rates between 4.25 and 4.5%. And that's how you want to read this when you go to page 4, not page 3 for the dot plots, is that this is going from 4.25, 4.5, 4.75, and then 5%. And you know how to read the rest of it. And only 2 of them believes that it should be between 4 and 4.25%. So they got 2 individuals circling between these two, 4% and 4.25%. And the rest of them, the other half of the committee members, believe that the Fed funds rates will be between 3.5 and 4%. So there's a good chance that they could cut rates possibly 3 times, maybe just twice, or maybe one of the meetings is at 50 basis points instead of 25 basis points. And that's why I go on live stream and I just do these research just to see what the Federal Reserve might do, because they will make an impact on borrowing money and how the Federal Reserve is going to cut interest rates and how that's going to affect your cash savings. And this is very, very important for you to pay attention to as well. Now, here is where I disagree with the committee's decision to keep rates pinned at that 4.25 to 4.5% level when inflation is down between 2 and 2.5%. The argument that we need to maintain these painfully high rates to fight it just falls apart, because that means the gap between the Fed funds rate and the actual inflation data is simply too wide. The real danger now isn't that inflation is going to suddenly spike back to 7 to 8%. The real danger is that the Fed's policy is putting the brakes on the economy so hard that it's going to, cause real damage to the job market. And we won't get another chance to change course until the next meeting on July 30th. And let me tell you, no one is expecting a cut then either. And the expectation for a rate cut is now in the September FOMC meeting. Now, looking to the next 2 meetings, July 30th and September 17th, the market predictions are telling a pretty clear story. This isn't just my opinion. This is based on the CME Fed Watch tool, which analyzes futures contracts to predict what investors are betting on. And for the meeting scheduled on July 30th, the tool is showing about 87 to 88% probability that the Fed will do exactly what they did today, which is nothing. And they'll keep rates right where they are, and only a 12% chance of a cut. Is this the final decision? Not necessarily, but it's looking more and more like the Fed will keep the rates where they are. And what comes next for September 17th, all eyes are now on the meeting after on September 17th. And looking at the probability for that date, the market is finally pricing in a interest rate cut. It is showing about a 58% chance that they'll cut rates by a quarter point down to a range of 4% to 4.25%. And that's the first real glimmer of hope for a policy change. But a 58% chance is hardly a sure thing. And that still leaves a 42% chance that they just hold rates steady yet again. And the market is basically saying it's a coin toss, but it's leaning towards September right now. And there's a 7.3% chance that it's going to cut 50 basis points down to 3.75 to 4%. But if I were a betting man, I would say they're going to cut rates in September by 25 basis points. Now, here's what I think. The Federal Reserve's decision today to ignore these signs and keep interest rates at a restrictive level is a huge gamble. And they are so focused on killing the last ghost of inflation that they risk doing long-term damage to the labor market. And they could very well turn these small cracks into a major fracture. As someone who's focused all these years on helping people achieve financial independence, I spend my days analyzing inflation data, GDP numbers, and unemployment statistics. It's just glamorous work, but it's necessary because these numbers tell the real story of what's happening to regular people's lives. And if you're thinking about changing jobs, if you're worried about layoffs at your current company, you need to be extra, extra careful right now. This isn't the time to take unnecessary risks with your career unless you feel like you can take it, right? And the job market is tougher than it appears on the surface, and it's probably going to get worse before it gets better. And not everyone is in a career field like lawyers, doctors, or law enforcement where things are steadier. And if you still want to switch jobs, you need to become undeniable. You need to be that person that any employer will hire. And however, in a tough job market, employers are going to become very selective about who they hire and how many they hire. I wish I had better news for you. I really do. But my job is not to make you feel good. It's to give you the information you need to make in order to make smart decisions. And I would love to hear your thoughts on this in the comment section down below. And this has been another beast of a video, and I hope you got a lot out of it.